Higher fuel costs for gasoline and diesel are now draining an extra $500 million from the American economy every single day. Not monthly, not quarterly, daily. And that figure is still rising. Since February 28th, when the United States and Israel carried out strikes on Iran, oil prices have surged by more than 50%. The Strait of Hormuz, a narrow 21-mile-wide passage responsible for transporting roughly one-fifth of the world's crude oil and natural gas, has effectively been shut down for the first time ever. Brent crude is now trading above $110 per barrel. Just 3 weeks ago, it was around $70. But the number you see at the gas station, the price you're paying at the pump, is actually the smallest part of what's coming next. There are 4 additional waves of rising costs already moving toward your finances, each larger than the last, and most people won't recognize them until it's too late to prepare. Hi, my name is Bryony, and I spend way much time thinking about why people who look financially reckless are sometimes better prepared for disaster than people who did everything right. If you've ever felt vaguely unsettled about how dependent your entire financial life is on one company, subscribe and hit. What I'm about to explain isn't just what's happening in the economy, it's also how your brain is quietly working against you in this moment, and what that could cost you if you don't take control. Let's begin with what's already visible: fuel prices. The national average has climbed from under $3 per gallon to around $3.70. In California, drivers are paying more than $5.30. Diesel, the fuel that powers the trucks delivering nearly everything you buy, has jumped about 36%, reaching close to $5.10 per gallon. Now, the typical American household spends about $2,500 annually on fuel, which comes out to roughly $50 per week. If that suddenly increases by $10 or $15 weekly, it doesn't seem catastrophic on its own, so your brain categorizes it as inconvenient but manageable and moves on. That classification is a mistake, and understanding why reveals something critical about how we process financial risk. Psychologists describe a concept called mental accounting, which explains how we subconsciously divide money into separate categories: gas, groceries, entertainment, savings. When one category suddenly increases, we don't logically rebalance everything. Instead, we react emotionally. We cut what feels optional. Eating out gets reduced, subscriptions are canceled, vacations get postponed, and the investment contributions you plan to increase this year quietly stay the same. The chief economist at the National Retail Federation has confirmed this exact behavior. When fuel costs rise, the first areas people cut are experiences, restaurants, movies, travel. Not because those things suddenly cost more, but because your brain reclassifies them as non-essential the moment a required expense increases. And that instinct is about to intensify, because fuel is only the first wave.
Right now, almost nobody is framing this situation accurately. The economic impact of this conflict isn't a single spike in prices. It's a sequence of shocks unfolding over time, each one arriving on its own schedule and building on the last. By the time most people fully understand what's happening, 4 out of the 5 waves will already have passed through their finances. The first wave you've already experienced: fuel. It appeared almost immediately. The second wave is beginning to show up now: groceries, especially perishable items like produce, meat, and dairy, products that can't sit in storage waiting for conditions to improve. Diesel powers the refrigerated trucks that transport these goods. When diesel jumps by over a third, the cost of moving fresh food rises sharply. Supply chain analysts have pointed out that grocery stores will likely be the next place consumers notice price increases after gas stations. And the more perishable the item, the more exposed it is to these rising transportation costs. However, stores don't increase prices overnight. Many will try to absorb these higher costs temporarily, just as they did with tariffs in recent years. The problem is that they've already been absorbing those earlier increases. There's very little margin left to handle another surge. An economics professor from Boston College warned that if oil prices remain elevated for any significant period, businesses won't be able to continue absorbing these costs, and once they stop, prices at the register will rise quickly. The third wave hasn't arrived yet, but it's already locked in: fertilizer. This is the one that should genuinely concern you because of how delayed and hidden its impact is. Energy accounts for as much as 80% of fertilizer production costs. Several countries affected by the conflict, Iran, Qatar, Saudi Arabia, Bahrain, and the UAE, are major global producers, and about 1/3 of the world's fertilizer supply moves through the same critical waterway that is currently disrupted. That means the food you'll be buying later this year is becoming more expensive right now due to higher input costs that farmers are already paying. You likely won't feel this until months from now, and by then, there will be no way to prepare for it. By that point, most people won't even connect the higher food prices back to what's happening today.
The fourth wave is air travel. The cost of jet fuel has climbed by roughly 85% since the conflict began. Airlines across the world, from major international carriers to regional operators, have already started announcing fare increases. And unlike gasoline prices, which can change daily, airlines build fuel costs into ticket pricing months ahead of time. That means even if oil prices dropped tomorrow, ticket prices wouldn't fall immediately. If you're planning to travel in the coming months, expect noticeably higher costs, and those prices are likely to remain elevated for longer than most people anticipate. The fifth wave is the one that very few people have fully connected yet: interest rates. Before this escalation, many expected central banks to begin cutting rates this year, which would have reduced borrowing costs for mortgages, car loans, and credit cards. That expectation has now shifted dramatically. Some economists believe rate cuts may not happen until much later than originally projected, and if inflation continues to accelerate, rates could even increase further. If you were planning to purchase a home, refinance existing debt, or take on new financing, the financial equation has just changed. One leading economist pointed out that when inflation shocks combined with geopolitical uncertainty, consumer behavior shifts in a very specific way. People don't just reduce spending, they pause major decisions entirely. Purchases like homes, vehicles, and renovations get delayed, not necessarily because people can't afford them today, but because they no longer feel confident about what they'll be able to afford in the near future. When that hesitation happens across millions of households at the same time, it creates a broader slowdown. That collective pause has the power to drag down overall economic activity. So here's something to think about. When you first heard that oil prices were rising because of geopolitical tensions, how many of these downstream effects did you immediately connect? Maybe one? Possibly two. That's completely normal. But that normal reaction is also where the problem begins.
There's a well-studied concept in behavioral psychology known as anchoring bias. When you're faced with a complex situation that has multiple layers, your brain doesn't evaluate everything at once. Instead, it locks on to the most visible piece of information and uses that as a shortcut to represent the entire situation. Right now, for most people, that anchor is the number displayed at the gas station. Whether it's 370, 420, or 530, that single figure becomes the reference point for judging the full economic impact of what's happening. And because fuel prices feel frustrating but still manageable, your internal system categorizes the entire situation as a temporary inconvenience rather than a serious threat. Meanwhile, economists are warning that fuel prices alone could push monthly inflation significantly higher in a very short period. And that's before factoring in rising grocery costs, increased production expenses, higher travel prices, and the ripple effects across every product that depends on transportation. The scale of this disruption is far larger than what most people are currently perceiving. A similar pattern played out not long ago. When geopolitical tensions triggered energy price spikes in the past, the initial reaction was mild concern. But over time, those increases spread into nearly every part of the economy: housing, services, food, and everyday goods. By the time the full impact became clear, purchasing power had already taken a significant hit. This isn't about being uninformed, it's about how human psychology naturally simplifies complex problems. Recognizing that tendency is the first step toward making better decisions. Now let's shift to what's causing the most immediate emotional reaction: your investments. Market volatility has increased noticeably. Major indices have pulled back from their recent highs, and that movement alone is enough to create anxiety for many investors.
But the broader picture shows that this isn't isolated to one sector or one group of companies. The impact is widespread, affecting large corporations, smaller businesses, and growth-focused sectors alike. Even assets that are typically considered stable or defensive aren't behaving as predictably as people expect. And when all of that uncertainty hits at once, it triggers something deeper than logic. It activates your instinctive response to potential loss. That reaction is rooted in what psychologists call loss aversion. Studies have shown that the emotional impact of losing money is significantly stronger than the satisfaction of gaining the same amount. In practical terms, a drop in your portfolio doesn't just feel like a loss, it feels amplified, urgent, and threatening. This response isn't a flaw, it's part of how humans evolved to survive. Avoiding losses once had real immediate consequences, but in modern financial systems, that same instinct can push you toward decisions that hurt you long term. When markets decline during periods of uncertainty, the natural impulse is to step away, to sell, to move to cash, to protect what remains. It feels like the safest choice in the moment. But history shows a different outcome. Data from multiple global events indicates that market declines during geopolitical crises are often shorter and less severe than people expect. And more importantly, recoveries tend to follow, sometimes sooner than anticipated. Investors who react emotionally and exit the market during downturns often lock in their losses. Those who remain invested are positioned to benefit when conditions stabilize. There's another challenge that makes this even harder. The market's strongest recovery days often occur very close to its worst declines. They cluster together. Missing just a handful of those strong recovery days over a long period can significantly reduce overall returns, and those days are nearly impossible to predict in real time. This creates what many experts refer to as the behavior gap, the difference between what markets deliver and what individual investors actually earn. And that gap exists largely because of timing decisions driven by emotion rather than strategy. This doesn't mean there's no risk. There is. One scenario that continues to concern economists is a combination of rising inflation and slowing economic growth occurring at the same time. It's a difficult environment because the usual tools used to fix one problem can worsen the other. And that's where uncertainty becomes more complex, not just in markets, but across the entire economy. This type of environment creates a difficult balancing act for policymakers. Efforts to slow inflation often involve keeping interest rates elevated, which can reduce spending and slow growth. On the other hand, measures designed to stimulate growth can add pressure to already rising prices. That tension leaves very little room for clean solutions. Central banks are already in a position where any decision carries trade-offs. Holding rates steady may help avoid further slowing the economy, but it doesn't immediately resolve inflation pressures. Increasing rates could control inflation more aggressively, but it also raises the risk of pushing economic activity into contraction. If the current situation continues and energy disruptions persist, some analysts believe commodity prices could climb even higher. At that point, the impact would move beyond short-term inconvenience and begin affecting long-term financial stability for households and businesses alike. History provides several examples where sharp increases in energy costs were followed by broader economic slowdowns. These patterns don't guarantee the same outcome every time, but they do highlight how interconnected energy prices are with overall economic health. Even when conditions eventually improve, the recovery process tends to move slowly. Prices often rise quickly when costs increase, but they take much longer to come back down once those pressures ease. This delayed adjustment means that even after the underlying issue is resolved, its effects can continue to be felt for an extended period. So while the situation may stabilize at some point, the financial impact doesn't disappear overnight. It lingers, gradually working its way through supply chains, pricing structures, and consumer behavior. That's why focusing only on what's happening today can be misleading. The real effect is spread out over time. And that brings us to the most important part of this entire conversation: what you can actually control. Because ultimately, the difference between people who come out of periods like this in a stronger position and those who struggle has very little to do with the event itself. It comes down to how they respond while it's happening. The first and most important step is resisting the urge to make sudden emotional decisions with your investments. Moving everything into cash might feel like protection, but it introduces a different kind of risk, missing future growth and losing purchasing power to inflation. There is no completely risk-free position. Avoiding one type of risk usually means taking on another. Next, take a serious look at your financial safety net. Having several months of essential expenses set aside in an accessible account provides more than just financial support. It gives you stability. When you know you have a buffer, you're far less likely to react impulsively under pressure. That sense of security is often overlooked, but it plays a critical role in decision-making. Without it, every piece of negative news feels more urgent and more personal. Then, review your spending before additional cost increases fully take hold. Some changes are already happening and others are likely on the way. Adjusting early gives you more control and prevents you from having to make rushed decisions later. Focus on reducing non-essential expenses where possible and redirecting that money towards savings or financial flexibility. These small adjustments may not feel significant in the moment, but over time, they build resilience. If you're investing regularly, maintaining that consistency is key. It may feel uncomfortable, especially during volatility, but disciplined investing strategies are designed for exactly these kinds of environments. Periods of uncertainty often create opportunities that only benefit those who stay consistent while others pull back. Finally, take time to understand how broader changes, like rising costs or shifting interest rates, specifically affect your situation. The more clarity you have, the more confident and intentional your decisions will be. Because in uncertain times, clarity is one of the most valuable advantages you can have. This is where awareness turns into action. Once you understand how these shifts affect your finances, you can begin making small, intentional adjustments that position you more securely over time. If rising costs are putting pressure on your monthly budget, identifying those pressure points early allows you to respond before they become overwhelming. Even minor changes, like adjusting spending habits or reallocating funds, can create meaningful breathing room. If debt is part of your financial picture, especially high-interest debt, prioritizing it becomes even more important in this environment. As borrowing costs remain elevated, carrying balances becomes increasingly expensive, which slows your overall financial progress. For those running businesses, staying flexible is critical. Cost structures may be changing quickly, and adapting early, whether through renegotiation, efficiency improvements, or operational adjustments, can make a significant difference in maintaining stability. One of the most overlooked advantages during uncertain periods is simply acting sooner rather than later. Delayed decisions often lead to limited options, while early action provides flexibility and control. Over time, these proactive choices begin to separate outcomes, not because they are dramatic or complex, but because they are consistent and timely. And that difference becomes more visible as conditions continue to evolve. At the same time, it's important to manage the flow of information you're consuming. Constant exposure to negative headlines can distort perception and increase stress without improving decision-making. Staying informed is valuable, but there's a point where more information stops being helpful and starts becoming overwhelming. Once you've taken practical steps to strengthen your position, giving yourself space from constant updates can actually support better long-term thinking. Because clear thinking, not constant reacting, is what leads to better financial outcomes. And that brings everything back to a simple but powerful idea. You don't control the external events, but you do control how you respond to them. If this changed the way you're thinking about the next few months, drop a comment and share the first move you're planning to make. You've been through uncertainty before, even if it didn't look exactly like this. And just like those moments, this one will eventually pass. The difference is how you position yourself while it's unfolding. Right now, you have the advantage of awareness. You're thinking ahead, asking questions, and paying attention to signals that most people will ignore until much later. That alone puts you in a stronger position than the majority. But awareness without action doesn't create results. What matters is what you do next, the small decisions you make today, how you spend, how you save, how you invest. Those are the things that will quietly shape your financial situation over the coming months. And those decisions don't need to be dramatic to be effective. In fact, the most powerful changes are usually the ones that feel almost insignificant at first. Adjusting a habit, shifting a priority, staying consistent when it feels uncomfortable, those are the actions that compound over time. As conditions continue to shift, there will always be new headlines, new predictions, and new reasons to feel uncertain. That part doesn't go away. What can change is how you respond to it. Instead of reacting to every update, you focus on the plan you've already started building. You make adjustments when necessary, but you don't abandon your strategy based on short-term noise. That level of consistency is what creates stability in an unstable environment. Because at the end of the day, this isn't just about markets or prices or economic cycles. It's about control. And the more intentional your actions are right now, the more control you keep moving forward. If this changed the way you're thinking about the next few months, drop a comment and share the first move you're planning to make. And if you haven't subscribed yet, now is the time to do it. This situation is still unfolding, and so is your opportunity to stay ahead of it.